My name is Jake, welcome to the channel. In today's video, we're going to do another Review My Pie video where I review subscriber portfolios. For those of you that are new to the channel, I'm in my mid-30s and I'm looking to retire in my mid-40s. My wife and I, we invest for dividend cash flow. We're looking for investments like individual companies, ETFs that are paying a dividend and paying me as a shareholder to own a stake in either an individual business or ETF. So I'm looking for cash flow from my investments. My goal is not to buy low and sell high. I started this YouTube channel here last year to help new or beginner investors learn about the concept of dividend growth investing. And throughout my time here on YouTube, I've decided to focus on three topics. The first being dividend growth investing. That's all things dividends. The second is the Review My Pie series here, where I talk about and review subscriber portfolios and share with the community what other people are investing in and share my thoughts and opinions on them. And lastly, the Financial Independence Retire Early series from the channel here is where I talk about all things FIRE related. So for those of you that are maybe unfamiliar with the FIRE movement, FIRE stands for Financial Independence Retire Early, looking to reach a state where I'm no longer required to work a 9-to-5 job to pay for my living expenses, so that my assets, my real estate or my dividend portfolio can fully cover my living expenses. In today's video, we're going to focus on 4 portfolios. The first portfolio is going to be from an individual that is 30 years old and is from Florida. The second portfolio is from a 13-year-old. Now, I can't make this up. Legitimately 13, unless it was a typo in the email, which I don't think it was, is from a 13-year-old. So I'm really excited about this portfolio. Portfolio 3 is from a 21-year-old. Portfolio 4 is from an individual that is 45 years old. The other 3 here, I'm unsure of their location. They didn't state in the email their location. So if you would like me to review your portfolio in a future video, shoot me over in an email. I have my email address in the description below. Please add a little bit of context, your age, where you're from. Are you from, the US? Are you international? Where are you from? And your goals. What are you looking to do with your portfolio? And also, is it in a taxable account? Is it in a Roth account? And your timeline. Are you looking to tap into the dividends in the next 10 years, 20 years, and as well as how much you're funding the portfolio on a monthly basis? As always, I'm not a licensed financial advisor, so all the information in this video and on my channel in general, they're merely my opinion and meant for your entertainment. It's not meant as financial advice, so please be aware of that throughout the video. All right, the first portfolio is from Nick. Nick writes, "Thanks for YouTube content, very educational. Here's about 2 months here in about 2 months, I will be inheriting about $250,000 in brokerage assets and $750,000 in an inherited IRA that I will need to bleed out over 10 years, ideally just transferring it from my IRA to my brokerage. Also maxing out our Roths with growth mutual funds outside of this." Okay. I'm trying to figure out if I want to manage this money myself or hire a financial advisor to do it for me. So I just opened an M1 brokerage account to get my feet wet and see if I like managing my own portfolio, opposed to just buying a no-fee growth mutual fund and rarely checking on it and managing. Okay, interesting. Here are some additional details about my goals. I'm 30 years old and would like to be financially independent in 10 years at age 40. In 10 years, my wife and I would love to have $40,000 to $60,000 in dividends per year to cover most living expenses. Okay, so 40 to 60, that's kind of a big spread. That's a $20,000 spread. So that would be the first thing that I would, recommend you do, Nick, is understand, okay, am I going for 40,000 or am I going for 60,000? Because that's a pretty big gap between the two. All right, so you also mentioned some questions here. So let's go down here, the bottom. Do I have too many holdings? Okay, we'll take a look at your portfolio. I haven't looked at it yet because I only put about $100 in to get my feet wet. All right, so it looks like you have a couple. I don't know how many holdings you have in there, but we'll check that out in a second. How is my percentage allocation to ETF, real estate, and individual stocks? How is my sector allocation with the individual stocks? If I go this route, would you suggest dollar cost averaging the inheritance money over like a year, maybe $5,000 a week, or instead of dumping the lump sum on day one? Lump sum seems dangerous, especially with the election coming up. All right, cool. So Nick, all right, this is really interesting. You're in a unique situation where not a lot of us will be in, whether currently in our 30s or maybe even ever in our lives. So you're in a very unique situation. The first question you ask with, the advisor, the very first thing. So once again, I'm not a financial advisor, so I can't give professional financial advice. But in my opinion, I think that if you're dealing with $750,000 in an inherited IRA, I would make sure, if I was in your shoes, to make sure that you understand the laws and the fees associated with an inherited IRA. There are some conditions that you do have to consider when you're inheriting a IRA, if it's a Roth IRA, if it's a traditional IRA. So I would consider consulting a financial advisor on what to do with that account. When it comes to investing, I believe every individual is capable of doing it yourself when it comes to managing your own investments. Okay, so when it comes to the investments, I think do it yourself is absolutely feasible and anyone could do it. Okay, so those are two separate things though. How to manage the actual accounts, to optimize the efficiencies there with the taxes and the fees, and then the actual managing of the investments. Okay, so if you're looking to retire in 10 years, man, if you have that much money, I mean, you could, and you're looking to get 40 to 60K, you could do that in half the time. You could do that in 5 years. You could do that in 3 years if you did it right. So understand that the 10 years, I mean, you're not limited. I mean, you don't have to do it in 10 years. You could do it much earlier. And it all depends on optimizing your portfolio, which we'll get to in a second. Okay, so let's take a look at your portfolio. Alrighty, Nick, so your portfolio is up 80% over the last 5 years. That's not counting the reinvestment of dividends. It has a small payout ratio, very small. This is a good payout ratio. You have 94 holdings. Okay, so you have 94 holdings based off of your email. Your email sounded like you were unsure of whether or not you wanted to manage your, do it yourself or not. So this is my first piece of advice or feedback to you is, make it as simple as possible. If you're unsure if this is something that you want to do, keep it very straightforward, keep it very simple. Especially, I mean, man, you're dealing with a lot of money. And even if you didn't inherit it, I mean, this is your hard-earned money. And I would recommend this to anyone. Really keep it simple. And so 94 holdings, I don't think for most people that's the route to go. Especially if you're new to investing, if this is not your hobby, I would recommend that you don't go with 94 holdings. And that's just my opinion, but let's take a look and see what you have here. So you have it broken down by ETFs, individual stocks, and real estate. So looking at the allocation, 5% in real estate, that's completely fine. I mean, you could even go up to 10%. 15% if you wanted to. ETFs, I like that you have ETFs in here. I think for regular investors, I think ETFs is really a good way to go. In my portfolio, I have 60% of my portfolio allocated to ETFs. So let's see what ETFs you have in here. You have VIG, SCHD, VYM, DGRO, and VOO. These are all high quality ETFs. These are great ETFs. You cannot go wrong with any of these ETFs. Okay, so you said that you have a lump sum of money that you're looking to invest. Okay, I want to make sure that I don't miss out on that question. When it comes, let's address that question first. So when it comes to the lump sum, if you're getting 250K or 750K, what do you do with that? Do you invest it all at once? Do you spread it out? I've gotten this question dozens and dozens of times. I've asked it myself. Many people will never be faced with this question because they don't come into this situation. And so I've heard many prominent investors like Warren Buffett, John Bogle, the founder of Vanguard, talk about this specific question. And the majority of times it's more advantageous to be the time in the market than timing the market. However, I believe that for most investors, and this is what John Bogle said as well, is to spread it out. Spread it out over a few quarters. I personally, if I were to get a lump sum of money like this, I would not invest it all at once. I would spread it out over maybe 6 months to a year. You mentioned the election. That's a great example. Maybe you invest part of it here now, and then you spread it out towards the end of this year and the beginning of next year. To expand on that, no one knows. No one knows what's going to happen in the market. We could go down 30% again right after the election. We could go up 50%. No one truly knows, and so that's why there's really you have to do what makes you feel comfortable and educate yourself on what makes the most sense for you. So I hope that answers your question. If I were in that situation, I would me personally, I would invest some now, I would invest some after the election, and I would invest some next year. That's me personally. All right, so looking at your portfolio, looking at your ETFs here, you have really high quality ETFs. You got VIG and VOO. So because of your timeline, the next 10 years, I would recommend you lower VIG. VIG is a great dividend growth ETF. It's a great ETF, but the starting yield is too low. If you had 20 plus years for this to compound, I would say go for it. VIG is great. But because you're looking to tap into the dividends 10 years or even actually less than 10 years, in my opinion, depending on a few factors, but you could make it happen, I would recommend putting VIG down to 5 or 10%. And the same thing with VOO. VOO is a great ETF. If you're looking, and now this really comes down to the question. If you're looking to 100% live off of the dividends and not sell your assets, sell them to pay for your expenses or whatever, then you want to skew it more towards the current yield given your time horizon. If you were in your early 20s and you had 20 or 30 years to go, then yeah, of course. But given your time horizon, I would recommend lowering it. What you could do is you could increase VOIM and SCHD. If you look at SCHD, it has double the dividend yield, right? Okay, so SCHD is still growing 7, 8, 9% year over year, the same as VOO, but with your time horizon, this is going to be more advantageous for you. Assuming that you want to live off of the cash flow and you don't want to sell out of the stocks. That's very, very important. If you're looking to sell out of your holdings to fund your expenses, then yeah, VOO and VIG makes sense. VYM, you could also increase that. VYM is not displaying correctly in M1 Finance. I shared this in a previous video. They have a yield closer to around 4% currently. So this is actually incorrect. But yeah, so VOIM, SCHD, I would bump those up and I would reduce VIG, for example. Once again, given your time horizon. Looking at your individual stocks, you have it broken up by consumer staple, tech, industrial, healthcare, consumer discretionary. Okay, and so once again, the allocation here really depends on your goal. If you're looking to 100%, and I may be repeating myself, but let me just say it one more time. If you're looking to retire in the next 10 years, you really want to focus on the current yield plus, individual companies or ETFs that are still growing 7, 8, 10% year over year. Consumer staples, you got Walmart, Procter & Gamble, Kimberly-Clark, Coke. My portfolio is set up fairly similarly, actually. Some of these you have in there that are the same as mine. Some of them are different. I like the way that you have it set up. I like, for me personally, I like going for these bigger established companies because it really helps you sleep at night. They have a great track record. They have a great growth record. For example, Costco, great company, but given the current yield, like I said, if you're looking to live off of the dividend, it makes sense doing what you're doing. So good job. Technology, 18%. Okay, so once again, when it comes to your goals, if you're looking to live off of your dividends, 18% is going to be a little bit high, in my opinion. You're not even getting a current yield of 1%, but 18% of this slice is in technology. And you have quite a lot of holdings in here. Okay, so it sounds like these companies are something that may be interesting to you. And I think you have 19 in here. Okay, so this would be my recommendation. Unless you're 100% passionate about these companies and you want to follow up on them, I would recommend taking them out. And I would recommend sticking with maybe just a handful and just focusing on high quality ETFs like VGT and QQQ that tracks the NASDAQ. And then having Microsoft, Apple, and Visa in there, and Tesla, for example. But if you're not planning on following up on Cisco, Intel, Accenture, NVIDIA, I would recommend going with just the ETFs. And that's my opinion. If you were planning on selling out of these, I mean, that makes sense. But once again, it comes back to your ultimate goals. And if you're looking to live off of the dividends, I would even recommend lowering this. If you're not, then, and if your time horizon is longer, then, that could make sense. So it could go both ways with that slice. Industrials, you got waste management, 3M. These are great. These are great. I think the majority of these, with the exception of a few, are in my portfolio. These are all great. These are great industrial companies. Great starting yield as well. Healthcare, Johnson & Johnson, AbbVie. These are all really great. You got 40% in Johnson & Johnson. Great. AbbVie. Really, really good. Consumer discretionary at 12%. I think, yeah. So I love Disney. I think Disney belongs in every portfolio. In your scenario, I would lower Disney. I think Disney is too high. Once again, assuming that you're looking to live off of your dividends, you could increase McDonald's, Target, and Starbucks. The others here with Nike, the starting yield is just too low. With Marriott, the starting yield is too low, and that's why I would recommend bumping up McDonald's, which has a higher starting yield. That's my opinion. Utilities, energy, you got NextEra Energy, Chevron, Duke. Chevron is, yeah, okay. Utilities and energy. Yeah, this is fine. NextEra Energy, Duke, Chevron, American States Water. That's fine. That looks good. Financials, yeah, that also looks fine. Royal Bank of Canada is a good one. JP Morgan's good. Wells Fargo, yeah, it's fine. I was just so disappointed by the 80% dividend cut by Wells Fargo. But yeah. That looks good. Telecom, Verizon, AT&T, and Comcast. I have the exact same thing. This is fine. The one thing that you could consider, once again, is with Comcast, you're getting a much lower yield compared to a Verizon or an AT&T. So understand, okay, it could work this way. You could lower Comcast and increase the others, but this is absolutely fine as well. Materials, what do you got in here? Oh, these are really good. So you got the Vanguard Materials Index ETF, really, really good. PPG, really good. You could also go with Sherwin-Williams, really good. Ecolab, great. Air Products and Chemicals, these are great. These are three really, really high quality material companies. You're getting a lower starting yield, but these are high quality materials companies. Okay, so going over to your last slice here in real estate, you got VNQ, SEH, USRT. These are my three favorite REIT ETFs, by the way. Really good, high quality ETFs. You got AMT, you got Crown Castle, Cyrus One, Digital Realty. These are really, really good. You must be following my channel because these are really high quality ETFs. You got data centers, you got cell towers. This is great. All right, Nick, so I think your portfolio is really strong. I would recommend taking a look at the allocations in your ETFs, also in the individual stocks, taking a look at the allocation within the individual holdings here. With tech, for example, I could see it go either way, but when it comes to all the holdings here, I would reevaluate that strategy if that's something that you could see yourself doing long term. What it comes down to is try to think about putting yourself in the position where you're fast forwarding 10 years. In 10 years, you're retiring. You quit your job and you're relying on your portfolio to fund your living expenses. And so you want to think about, okay, if that were to happen tomorrow, would I be comfortable with the way my portfolio is set up today to do that tomorrow? That's the question you want to ask yourself, and that will help guide you in the direction that you want to go. So once again, thank you so much, Nick, for sending over your portfolio. I hope that this was helpful. I think you're in a really, really unique situation. I think you're making the right strides. I think when it comes to what you're trying to do is I would recommend not making any rash decisions with the money right away. You're in a very unique situation. Educate yourself on the portfolios. I hope that this was helpful. All right, let's take a look at the next one. The next one is from Ambulant Gaming. The person here did not mention their name. They say, "Hi, Jake, really love your series and I hope you can get to this. Thank you so much. I appreciate the kind words. You can feature it in a video or I would love if you would send me an email with your opinion. I do not have M1 Finance, so I'm sending you my dividend position on Google Sheets. Really hope this is okay. The screenshots will be below. I'm really interested in the stock market. Anyways, so age 13, holy cow. I know I'm really lucky. My parents opened a custodial account for me. Custodial account, anybody that knows that, it's beneficial for the parents because the parents are not paying the taxes on the custodial account. So the dividends, they're not being taxed on it. So it's actually really, really smart from the parents. Starting amount is $3,000, half of my savings. Wow. 13-year-old with $3,000 in savings. That's amazing. Then about $100 a month and any money I can make on the side from YouTube. He has a small channel. Okay, very cool. Hoping to get monetized in the next 6 months or a year. Not a finance channel, by the way. Okay, I can assume by the name, it's probably a gaming channel, which is amazing. So that is great. I can't believe it. You're 13 years old and you're already starting to think about finance and investing. You really have some smart parents. Goals, 50,000 portfolio by the age of 20. Holy cow, man, that's amazing. I know this may be ambitious. Hopefully I will get there. So the cool thing about this is you want to set goals, right? The fact that it's 50K, it might seem impossible today, but you know what? If you set the goal of 20K, then you know that doesn't help you either. So setting ambitious goals, I mean, that's great. You go on to say here, really hoping for another correction to get good prices. All right. I read a ton about the stock market and watch as much as I can on the internet, but you and others are absolutely more experienced than me. I have been paper trading since about January and missed the March lows because my account wasn't set up all the way. Hopefully you can read this and give me some feedback. I also have a small position in Microsoft, Facebook, and Tesla, but I left that out. I hope you get to this. All right, let's take a look at your portfolio. It looks like you have Johnson & Johnson, 3M, T. Rowe, Waste Management, AbbVie, Genuine Parts, Realty Income, Bank of Montreal, Coca-Cola, Store Capital, and Altria Group. Okay, these are really established dividend growth companies. A lot of these are a little bit more, I would say, these are the boring dividend stocks that you would see, your parents invest in. This is not your Microsoft. This isn't your Apple. This isn't your Nvidia, your Visa. I think because you're 13 years old, I don't think you think like a regular 13-year-old. And most people watching this video probably think, okay, well, if you're 13, you should probably invest everything into, I don't know, Microsoft and Apple, right? Because of your time horizon. You have 40 years to go. I'm not going to say that because I think you're different. You're 13 years old, you're thinking very different. You don't think like a regular 13-year-old, by no means. And so I don't think you're looking to retire at the traditional age of 65. I think you're looking to retire maybe in your 30s or maybe even your 40s, which is very, very possible what you're trying to do. So with that in mind, a lot of people watching the video might not understand my reaction. And my reaction is, I think you're on the right path. I think you're on the right path. However, I would challenge you to think a little bit differently when it comes to some of the individual holdings. Okay, and when I say you're on the right path, I think you're on the right path because I'm making the assumption that you're looking to retire in your mid-30s or early 40s. And so the investments that you have are not so far off from what I would actually think you should be doing. And so I think a lot of people may be a little bit confused when they watch this and they think, okay, well, Jake, why don't you say or recommend to invest in Nvidia or into Visa or into Microsoft? Because this dude, he's not looking to retire in his 60s. He's looking to retire early, okay? And so the investments that you're investing in, you're on the right track. I would encourage you to compare Coca-Cola and Pepsi, right? Coca-Cola is a great company. But given your time horizon, I'm assuming your time horizon is 20 years. That's 20 to 25. And so I would recommend looking at, okay, what is the percentage, your target allocation of your portfolio? How much is of that made up of, for example, 3M, Johnson & Johnson, Altria Group, compared to Waste Management? I think Waste Management is one of the best companies that you have here in your portfolio. If you're 13 years old, I hope that you have a higher allocation into Waste Management. Waste Management is, in my opinion, the best stock in your portfolio, given your circumstance and your age and your time horizon. Waste Management is by far my favorite. I think Johnson & Johnson is great. 3M is great. All these others are great. But what I would encourage you to do is Do a compare and contrast. Maybe, for example, if you were to go with AbbVie, okay, is AbbVie the right choice, or should I go with another pharmaceutical company like MDT or BDX, for example, right? But I think that you're on the right track. I think you are different, and I think you're different in a good way. You're not going to be retiring in your late 60s or late 50s. You're going to be retiring much earlier, and that's why I think you're on the right track. Keep doing what you're doing. Ask the question though, what I would recommend you do is understand realistically what is your timeline? Is your timeline 20 years or is it 30 years? And based off of that, I would optimize your portfolio, because I can tell you're into the math. You're different. So really optimize the numbers based off of your time horizon, whether we're talking 20 years or 30 years. And that will guide you in the direction that you need to go to pick the individual companies that you're looking to invest in. Thank you so much for sending over your portfolio. Thank you so much for reaching out. I am so jealous. I wish I started this early. I'm thinking 44 is young. Man, you're on track to achieve what very few people in life will do and be able to retire or at least be financially independent in your 30s. So congratulations. This is amazing. All right, let's take a look at the third portfolio here. The third portfolio is from Paul. Paul writes, "Hey, I just discovered your channel and I love what you're doing." Thank you so much, Paul. I really appreciate you saying that. I was wondering if you could review my pie. So a few pieces of information to Paul. Paul is 21 years old. So his goal here is to create another passive income stream and achieve FIRE. So financial independence, retiring early. Would like to retire as soon as possible, but am in no rush. Okay. Goal I would like to have with this portfolio is to make 10 grand a month from this portfolio. $10,000. Okay. That's a lot of money. It's in a taxable account, looking to contribute $250 a week to $1,000 a month. Okay. That's a good amount. And all right, well, let's take a look at your portfolio, Paul. You have a small expense ratio. You have a good dividend, a 3% dividend, and you have 33 holdings. So you would like to ideally retire sooner than later. You're investing about $1,000 a month. Okay, so let's take a look and see what holdings you have. You have it broken down by ETFs and then by sector. You got healthcare, consumer defensive, technology. Okay, let's take a look and see what ETFs you have in here. You got SPHD, VTI, VIG, and VOO. Okay, these are good ETFs. SPHD, I'm a little bit on the fence, but I think it's an okay ETF. It's one of the better monthly dividend ETFs out there. VTI is a great ETF for the FIRE movement. However, with VTI, the FIRE movement traditionally looks at VTI to sell out of VTI in early retirement. So the question that you have to ask yourself is, are you looking to live off of the dividends and not sell your shares? And if your answer to that is, yeah, Jake, I don't want to sell my shares, then you may want to reconsider some of the ETFs that you have in your portfolio. If you're looking to sell the shares in early retirement, this is absolutely great. But if you're looking to live off of the dividend, your time horizon may be a little bit longer than you think. With 1.5 dividend yield with VTI, VIG, this dividend yield is growing, yeah, but it's going to take much longer to really take advantage of that compounding snowball. And so I would recommend looking at other ETF alternatives in addition, maybe, that have a higher starting yield. My favorites are DGRO. It has about a 2.5% dividend growth rate. I also like VYM and SCHD. Okay, those are two that I have in my portfolio that I personally really like. Healthcare, let's see what you got in healthcare. You got Merck, you got Johnson & Johnson, AbbVie, Amgen. Yeah, these are all really, really good companies. I think these are fine given what you're looking to accomplish. Consumer defensive, you got Pepsi, Procter & Gamble, Coke, Target, Costco, and Estee Lauder. Yeah, these are all really, really good. One that you could also take a look at that I really like is Kimberly-Clark. Kimberly-Clark is another one, ticker symbol KMB. Let's see, what do you got in technology? Technology, Microsoft and Apple. I don't think anyone can go wrong with Microsoft and Apple. Another one that you could take a look at would be Texas Instruments, ticker TXN, but I think those are also great. Communication services, AT&T and Verizon, can't go wrong with those two. Those are great. Let's look at the target allocation. You got 10%. Yeah, that's fine. That can work. Let's see. With financial services, you got JP Morgan and Bank of America. Okay. It's kind of a lot to be allocated into two banks, but those are good banks. Consumer cyclical, you got McDonald's and Home Depot. These are great. I can't say anything against those two companies. Those are great. Real estate, what do you got in real estate? You got realty income. Okay, I think that's this is one of the better REITs out there. I think with your time horizon, I think it could work. I personally think 6% of my overall portfolio in one REIT. I don't know. For me personally, I'm on the fence about that, but I think it could work. It is a really, really high quality REIT. I think if you wanted to get more exposure to real estate, you're already getting exposure to real estate by having the S&P 500. Remember, you have VOO here, so you're already getting exposure to real estate. But if you wanted to get more exposure, you could get a good REIT ETF in VNQ, and you could add that to your portfolio, and you would expand your diversification into real estate. Bonds, you got 3%. Yeah, that's fine. Bonds, 3%. I wouldn't do anything more than 3% personally. Utilities, 2%. You got PPL, you got Dominion, Duke, and American States Water. That's fine. One that you could also look at or two of them that I like. I like Southern Company, ticker SO, and I like NextEra Energy, ticker NEE. Both really good companies. Industrials, 2%. You got 3M, Emerson, General Dynamics, and Waste Management. 2%. I personally, in my opinion, I think industrials deserves a little bit higher allocation than 2%. For example, financials and communications, me personally, I would lower those, and even consumer defensive, and I would increase industrials. I think industrials should be higher than 2%. Basic materials, 1%. Linda, yeah, that's fine. Okay, cool. So, Paul, I think your portfolio is good. I think, you're getting a 3% dividend yield. You have 33 holdings. You're 21 years old. It really comes down to, and you're investing about $1,000 a month. And you said that you wanted $10,000 a month in monthly cash flow. This is going to take you a long time. If you want $10,000 a month in cash flow, this is going to take you 20 plus years. It might even take you 30 years. If that's the rate that you're funding the portfolio. The way that you have it set up, it's going to take you 20, maybe 30 years. And it really comes down to, if that's your time horizon, I think you're off to a great start, and I would continue on your path. Maybe, the few adjustments that I mentioned here with the allocation, but understand that if you're investing $1,000 a month and you want $10,000 a month in cash flow, this is going to take you 20 or 30 years. So understand that. On my channel, I talk about three things: cutting consumer debt, cutting your expenses, and looking for new ways to earn money. So there's a few things that you can do. Over time, you're going to want to increase that monthly contribution by cutting your expenses, cutting consumer debt, and making more money. Side hustling. That's the honest truth about dividend growth investing, is it takes time. And so if your goal is $10,000 a month in dividend cash flow, you have to understand you got to aggressively fund your portfolio, and you have to expand your time horizon. Thank you so much for sending over your portfolio. All right, let's take a look at the last portfolio. The last portfolio is from David. David writes, Jake, I'm 45 and employed in information technology. My employer doesn't offer 401k, so I have rolled over all of my retirement accounts into a Roth IRA, and I'm contributing myself into it at about $500 a month, which currently means I'm maxing out contributions for the year each year. Okay, great. I'm focused on attempting to grow my retirement as quickly as possible, as I waited very late in life to get started. To that end, my pie is a combination of dividend growth investing and some risk-on style holdings that are growth investments. Okay, great. I recently rebalanced to take advantage of the giant dip in March and changed my allocations a bit to that end. Prior to that, I had a large allocation in the bonds gold pie slice and was able to use its value preservation effects to buy more shares in real estate and risk on at great prices during the dip and ride them back on. That is great. When you're holding bonds and gold, that rebalancing effect is very powerful. I don't talk a lot about that on my channel, but that can be very, very powerful. You continue to write here, my goals here were to maximize both growth and dividend yield while still doing my best to reduce downside risk. I really hope to continue growing this account until retirement and get to the point where I can roll half of it into a real estate and bond gold pie for income to live off of, while the other half of the portfolio continues to grow and provide lasting wealth. What do you think of my pie? Do you have any constructive criticism on my selections? Okay, so you don't go into effect of when you're looking to retire. So if you're looking to retire at 65, 55, so I'm going to take the assumption that because this is a Roth IRA we're talking about. So I'm going to make the assumption that you're looking to retire at 59 and a half. 59 and a half is when you can tap into the not only the contributions, but the growth of the portfolio without any penalties. So let's take a look at your portfolio. Okay, so you were up a whopping 583%. So this is incredible. This makes my portfolio, puts my portfolio to shame. Holy cow, 583%. You got a 5% dividend yield, and you have a good expense ratio. I mean, for an overall portfolio, you have 50 holdings, and this is in a Roth IRA. Holy wowzers. Okay, let's see what you have in here. So I like that you title it here, Risk On. All right, cool. So let's take a look and see what you have in the risk portfolio. You got Tesla, NVIDIA. Okay, you've got AMD in there. All right, so yeah, I mean, why not, right? I think right now, Tesla obviously doesn't pay a dividend right now. Tesla is up, I think, 400 or 500% over the last couple of months here, up 250. What about in the last 6 months? 200%. I mean, Tesla has just been, wait, what was that? Did I see that right? 900. Tesla's up 900% in a year. So yeah, Tesla is just crushing it. But yeah, I mean, it's in a Roth account. I mean, you could always, I don't talk about this on this channel because I'm not a big fan of buying and selling and timing the market. But if it worked out for you, it could work. I mean, that's why it's titled Risk, right? You could sell out of Tesla and buy, high quality dividend companies like 3M or Johnson & Johnson, McDonald's, and live off of the dividend forever, right? So there's a lot of opportunity here, and it's in a Roth IRA, so you got tax efficiency there. So this is great. Let's see what you got in real estate. So you got 20% in real estate. I think that's fine. I wouldn't personally go over 20% in your overall portfolio. That's just my opinion. You have an 11% dividend yield. Okay, so you got realty income. That's a great one. I'm not too familiar with CIM and ABR, to be honest. I haven't really followed up on these companies, so I can't really add a lot of context. I can talk about AGNC. AGNC is a little bit riskier. I mean, AGNC, it's all about the mortgage, and so the dividend is not going to be as consistent as it would be with realty income. With realty income, they've increased their dividend for over 25 years, right? They're a dividend aristocrat. So as a shareholder, you're going to get more dividends every single year. With AGNC, it's a little bit more up in the air. But obviously, I mean, they pay a much higher dividend, so you kind of get that with the whole package. So, but yeah, I mean, it's fine. I personally wouldn't recommend it to your average investor, but it could work. Let's see here. You got bonds and gold. So you're 45, having 10% in bonds and gold is completely fine. You got GLD. It's a good one. You got GOF and you got BLV. You got long-term bond. Okay. I personally like BND a little bit better than BLV. BND is the entire bond market from Vanguard. That's just my opinion. I like it a little bit better. Utility. So you got 5% in utility. You got Southern, Nextera Energy, Brookfield, Essential Utilities. I have this in my portfolio as well. UTF. I'm not really familiar with UTF. UTF, it has a 2.5% expense ratio. It has a high dividend, but I shared this on a video here not too long ago about the impact of high expense ratios. I'm not a big fan of of ETFs or mutual funds that have an expense ratio over 0.3%. That's just me personally, even if it has a higher dividend yield. I've talked about it in previous videos, but that's, I mean, wow. 2.5%, I personally am not a big fan of this ETF personally. But the others I think are fine. Tech and telecom. Let's see what you got in here. You got Netflix, Columbia, STK. I'm not familiar with this fund. Is it a growth fund? Yeah, it has a high expense ratio. Okay. AT&T, Microsoft, and Apple. Okay, great. What's interesting, though, is you have these ETFs with really high expense ratios, but your overall portfolio is really well balanced in terms of the overall expense ratio. That's why my reaction, if your overall portfolio expense ratio was 2% or 1.5%, my commentary would be very different. But given the overall portfolio, it doesn't concern me as much. Roth Industrials, Waste Management, Paycheck, Lockheed Martin, and 3M. Great. Healthcare, what do you got in healthcare? Johnson & Johnson, Bristol Myers, AbbVie, and Amgen. These are great. What do you got in financials? Access Holdings. I'm not familiar with this one. Okay. JP Morgan and Gain. Okay, great. Let's see. Energy and materials. ET. Okay, this is an MLP. So yeah, you're definitely going for the dividend yield. Okay. I mean, it's in a Roth IRA. Yeah, I mean, it can work, and you're looking to retire. You're probably here in the next 15 years. I mean, it could work. I mean, this is definitely an interesting strategy. I will say, David, this is a different type of a portfolio that I'm not used to reviewing, and I'm kind of intrigued by it. It's got. I like the overall balance of the portfolio, right? You got 50 holdings, but with that, you got a 5% dividend yield. So we're looking at the total portfolio. Like looking at the individual holdings, I'm a little bit skeptical on a few, but looking at the overall composition of your portfolio, the numbers are actually pretty good. 5% dividend yield, not a high expense ratio. I mean, it's kind of interesting. We looked at energy. Let's look at the ETFs. Got SPHD. I've heard a lot about this one lately, the covered calls ETF. I might do a video on this in the future. You got the Angel. This is also another one. This is, I think, a monthly. So this is monthly. This is monthly. This is monthly. Okay, so these are monthly for the most of them. Is DIV monthly? I can't remember if it is. I think it may be actually monthly. I'm not 100% sure though. Okay. Roth Consumer Defensive, Pepsi, Kimberly-Clark, Costco, and Clorox. Yeah, really recession-proof, high-quality companies. This is typically what I'm used to seeing. Like this is usually my world. Like this is what I'm used to looking at. The rest of these are very, very different to me. So it's intriguing to me to see them in the portfolio because this is not what I typically research. Disney, Shopify. Shopify is like Tesla. It's just blown up immensely. It's insane. Domino's and Amazon. Okay, so as I mentioned earlier, this portfolio is very different than what I'm used to reviewing. My world, like as a dividend growth investor, I'm really like I'm spending the majority of my time in the dividend aristocrats, the dividend contenders, the kings, like those companies with strong track records. And so I have more understanding and more experience with those companies versus more so companies that, you know, some of them that you have in your portfolio. But as I mentioned before, it's all about the overall portfolio. When I look into the individual companies in the portfolio, I kind of scratch my head, does this make sense? But when I look at the overall portfolio, you know, how it's set up and the numbers and the expense ratio, the dividend yield, the holdings, the performance, like it's really, really good. And so it's a different way of thinking. And I've said many times on my channel, there are many different roads that lead to success. And I think this is really, really interesting. David, thank you so much for sending over your portfolio. This was really interesting. I haven't seen a lot of portfolios set up this way. So this was really, really, really interesting to take a look at. Thank you everybody for watching the video. If you're new to the channel, I'd invite you to subscribe. If you would like me to review your portfolio in a future video, shoot me over an email in the link description below. in the description below, and make sure to send me a little bit of context, your age, where you're from, just to make the video a little bit interesting for all of you watching. Your goals, your time horizon, your monthly contributions, what account it's in, all of that fun stuff so that I can personalize it to you. And if you like today's video, give me a thumbs up, and I will catch everybody in the next video.